Hello, and welcome to the BNP Paribas Asset Management Talking Heads podcast. Every week, Talking Heads will bring you in-depth insights and analysis on the topics that really matter to investors. In this episode, we'll be discussing healthcare sector equities. I'm Daniel Morris, Chief Market Strategist, and I'm joined today by John Stevenson, Senior Portfolio Manager. Welcome, John, and thanks for joining me.
Well, thanks for having me.
It's a good time, I think, John, to be having this podcast since we recently had the first cut in quite a long time in policy rates from the Fed. And I think you're going to share with us how rising interest rates or falling interest rates have been a key factor for the performance of healthcare stocks over the last couple of years. If we then think about the outlook for equities more broadly, a lot of investors are counting on the reduction in interest rates. But at the same time, when we think about healthcare stocks, there's a lot going on at the company level, at the sector level, and maybe we can talk about that a bit as well. Let's start, though, with interest rates. You understand where we are in the interest rate cycle. First cut 50 basis points from the Fed. How does that impact the outlook, in your view, for healthcare stocks?
When you look at history, healthcare stocks have tended to outperform when central banks are cutting rates. And there's very logical reasons for that. It happens in the context of a weakening economy and decelerating inflation. And that means that other sectors of the economy have a bit more uncertainty, whereas in contrast, healthcare tends to be relatively inelastic in terms of its demand pictures. So from a risk-reward perspective, there's greater revenue earning certainty for healthcare relative to the broad market in those environments. And of course, lower discount rates are a big positive for small and mid-cap biotechnology and device companies, which are the lifeblood of innovation in the sector. Is this time going to be any different than prior history? I don't really see that being the case. And in fact, I could argue that the setup is actually uniquely favorable this time around, because we all recall that in 2023, healthcare actually saw the most significant underperformance relative to the broad market since 1999. So you had a really bad year last year, and I think that sets things up pretty well going forward. Specifically, I actually really like the setup for the most innovative areas of the market, which, as I mentioned, are small and mid-cap biopharmaceuticals and medical devices. And the group entered this cycle with a relatively stable performance year to date this year, after an 18 to 24 month bear market that was pretty ferocious. At the stock level, you're starting to see specific stocks that have fundamentally positive idiosyncratic events actually getting rewarded for those events, which is a stark contrast to the way those stocks were trading in the prior period. And that creates an environment where investors are much more willing to own these innovative stocks because they think they'll actually get rewarded for it. And of course, the lower interest rates create a backstop and a better financing environment that lessens the overhang on those equities as well.
I'd like to pick up on your comment about the performance of healthcare stocks. When the Fed is cutting rates, that's typically associated with a slowdown in growth and more often than not, a recession. And in fact, if we look at the last 5 cutting cycles from the Fed, in 4 out of those 5 instances, we ended up getting a recession, except this time we're not looking for that. We do expect a soft landing. But importantly for the sector, though, you're right that healthcare does tend to outperform when the Fed's cutting rates, even if you do end up with a recession. But the one time where we had a cutting cycle and did not have a recession, healthcare again was one of the best performing sectors. So I agree it should be a good environment for healthcare stocks. You mentioned, though, outside of the macro picture, innovation ultimately is going to be the driver for earnings and performance. Where then are some of the more interesting areas where you see innovation?
One of the areas that I think is particularly exciting right now is something called pulsed field ablation, or PFA. Essentially, this is an alternative energy source for treating atrial fibrillation. Now, a little background here. Atrial fibrillation is something probably people have heard. It's an abnormally rapidly beating heart, and the heart is unable to actually slow down. And this is really a byproduct of abnormal electrical signaling in the heart. And this AFib can ultimately lead to major sudden events such as heart attacks, strokes, and also progressive events such as the progression to heart failure. So clearly it's something that you want to address from a medical perspective. And historically, one of the interventional ways in which physicians have treated this is to ablate the heart directly with either heat or cold energy. So radio frequency or cryo energy to try to stop this electrical signaling creating this rapidly beating heart. But the problem is that cold energy creates imperfect ablations and heat energy has safety issues. So you never really had the perfect balance of risk and benefit. Pulse field ablation offers the efficacy of heat without the safety issues. And it's rapidly gaining share against alternative energy sources. And more importantly, it's opening up ablation procedures for a wider proportion of the population. So the number of procedures getting done is really accelerating significantly. And that's been a huge positive for some of the stocks in the market. In biopharmaceuticals, another area that we're seeing huge amounts of innovation is better delivery of chemotherapeutics. That's being enabled by the development of much better antibody drug conjugates. So historically, old school cancer treatment was dominated by the systemic delivery of chemotherapies. And the hope was that you'd essentially kill the cancer before you killed the patient. That's not exactly a great trade-off. And so people for years have wanted to be able to find a way to chaperone the chemotherapeutics directly to the cancer cells while mitigating the amount of systemic circulation and therefore the toxicity. They've tried this in the past, but prior constructs released the payload systemically and were not that beneficial. But more recently, we've actually been able to develop much better antibody drug conjugates, and that's actually caused an explosion in capital being deployed against these concepts. And it's a big theme that we're going to be seeing over the coming years. Another area in biopharmaceuticals is the effort to harness the power of T cells. Now, T cells are one of the many components of a human immune system, but they're trying to harness those to fight both cancer and autoimmunity. So you can essentially take T cells, engineer them, or create antibodies that bind to T cells and use the T cells to attack cancers. But you can also use those same technologies to use the T cells to attack another component of the immune system called B cells. And those B cells are important in autoimmune disease because they create these antibodies that attack healthy tissue. So if you can turn off those B cells by attacking them with T cells, you can reset the immune system and potentially almost cure severe autoimmune diseases such as lupus and really severe rheumatoid arthritis and other severe debilitating autoimmune diseases. So there's a lot of really cool stuff going on in healthcare at this point.
Of course, when we think about innovation, one of the big ones over the last couple of years that I think most everyone is aware of are the new obesity treatments. I think sadly we've come to realize it's not so simple as getting a shot and being thin and then having no worries. There's been surprises, in some areas complications. Can you talk a bit about healthcare stocks that are linked to the obesity treatments in the outlook?
As you mentioned, you can't really go anywhere without hearing about the new obesity drugs. And as a result, the stocks that are directly linked to those drugs have been rallying significantly. Obesity has been an issue that's been attempted to be addressed by the pharmaceutical industry for decades. These drugs, which are truly innovative and impactful, they're finally validating this is an enormous market. The weight loss that they're generating is profound. We're talking about 20 to 25% weight loss in people. That is a majorly life-changing impact for patients. And it's going to drive significant downstream medical benefits and cost savings to the system. But the issue is that expectations that are embedded in them are incredibly high, as are the valuations. And frankly, nothing is without risks and drawbacks. So when you look at these drugs, which are called incretins or GLP-1s, they are extremely expensive at this point, and that limits broad payer coverage because if payers were to adopt them, they would just blow out the budgets. There are also tolerability issues, and those can drive above normal discontinuation rates for the medications. And a significant portion of the weight loss that is attributable to these medications is actually lean muscle mass, which is incredibly important for health. And when people discontinue these medications, which, as I mentioned, is not infrequent, they regain the majority of the fat, but they don't regain the muscle. And that leaves these particular patients in a worse metabolic position than they would have been previously. So while there's a huge clinical benefit for those who are adherents to medications, there's still a huge opportunity for improvement upon these things and finding other niches in the market. So we see the long-term opportunity for price competition to drive better pharmacoeconomic value for the system. We also see the potential for novel mechanisms to improve upon the distribution of fat loss versus weight loss by either driving fat loss without impacting muscle. Or there are also drugs being evaluated that might actually increase muscle, which enhances your daily caloric needs and drives weight loss that way. And there's many other approaches being evaluated. But from a stock perspective, these valuations are rich, expectations are rich, and there's frankly still a lot of uncertainty long-term about what the market composition is going to look like in 5 or 10 years. And that's going to be really important for the stocks long-term.
You mentioned, John, earlier on about some of the challenges the sector has faced over the last couple of years, particularly in 2023. There were several headwinds. Can you talk about how those have evolved and what the outlook is now?
So last year, it felt like somewhat of a perfect storm of headwinds for the group. We were facing continual rising interest rates. Long-term yields were going higher, and people were arguing about the need for them to go even higher. So that was a massive headwind for the most innovative pockets of the market. The medical device segment of the market was negatively impacted by investors because of the perception that adoption of these obesity meds would actually eliminate a lot of the end markets for the medical device companies, which I always believed was erroneous. And then in other pockets of the market, if you looked at life science tools and contract research organizations, the financing overhang or the lack of financing for the most innovative pockets was impacting the end markets for life science tools companies. And also during the pandemic, there was a massive build in inventories for a lot of the consumable products that were related to manufacturing of biologics. Last year, we began the process of unwinding that inventory. And even in the managed care side of the world, you had a rebound in utilization rates for medical procedures and medical volumes at the same time as you had an unwind of the social safety nets, which was the expansion of Medicaid coverage in the United States for a broader population. When we came out of the pandemic, that was unwound as well. So there was just an abundance of headwinds last year. This year, the interest rate headwind has abated and now become a tailwind. The perception of an obesity adoption overhang on medtech is starting to abate gradually. If you look at life science tools and contract research organizations, the inventory build that had needed to be unwound, I think we're probably in the late stages of that. So that creates a bit of a better backdrop for those stocks. At the same time, the financing issues are abating because biotech financing has actually been pretty solid. If you look at the managed care universe, some of those headwinds are still persisting, because there are lingering enrollment reductions for Medicaid, which are impacting the margins for these companies. And utilization remains pretty strong. And that creates some uncertainty around the medical benefit ratios for these companies. So overall, I would say things are getting better. And importantly, they're getting better for the most innovative segments of the market. So I'm pretty optimistic.
On that note, John, if I summarize some of your key points, if we think about the macro picture, the fact that the Fed is cutting rates, historically at least, has created a positive environment for the sector. In addition, you're certainly still seeing a lot of innovation, which ultimately should drive earnings and stock performance. If we think about one of the key innovations, the obesity drugs, you acknowledged certainly a revolution, but not perfect. And opportunities perhaps, and some other companies that aren't directly manufacturing the drugs where we see high valuations to help improve the treatment and patient reaction. And then finally, you went through some of the headwinds the sector faced in 2023, but encouragingly, several of those have started to fade. Well, John, thank you very much for joining me.
You're welcome, and thanks for having me.
That's it for this week's episode of Talking Heads. If you would like more information, please reach out to your BNP Paribas Asset Management contact or check out Viewpoint, our website for investment insights at viewpoint.bnpparibas-am.com. We recommend subscribing to Talking Heads on your favorite podcast channel, such as YouTube or Spotify. You'll receive your podcast episodes every Tuesday afternoon. If you like Talking Heads, leave us a positive review and a nice rating. You've been listening to the BNP Paribas Asset Management Talking Heads podcast with me, Daniel Morris, and John Stevenson. Please do join me next week. Until then, take care.
This presentation includes a discussion on current market events and is not intended as investment advice or an offer of products or services by BNP Paribas Asset Management. Please keep in mind that the information and analysis in this presentation is only current as of the publication date.